Hey guys, Stockaholics. Appreciate you guys for being here today. Hope you guys are having a fantastic holiday season. Merry Christmas. Happy New Year. I wanted to talk a little bit about the monetary system. I know it's not a popular subject, but I think it is really important. And the more that I'm learning about it, the more that I'm seeing that this is kind of a basis for all kinds of knowledge in the stock market. And the more that I wish I had learned this sooner, and the more that I think that it is important to share this information with you guys. Now, the more that I study the monetary system, the more excited I've been to kind of make a video about it, although I know it's not a very popular topic. But there's a ton of things to talk about. There's all kinds of things. And I was thinking, how can I put this into one video? And the more I was thinking about it, I was like, if I'm going to do it justice, I'm not going to be able to do that, or at least to convey what I know to others. So I'm going to make this into a couple videos, maybe a series. We'll see how many. I'm thinking it's going to be at least 3 videos. And I don't expect it to be popular, but if you guys are like me and you want to become the best investor that you can become, I really do believe that understanding the monetary system is massively, massively important. So we'll call this episode 1. I once was blind, but I now can see. First of all, I'll be talking about why we should be learning all of this stuff. Second, I'll be talking about something called loss aversion. This is a common human behavior that if we want to become the best investors that we can be, something that we need to understand and do our best to overcome. Third, that there is an infinite amount of money at the Federal Reserve, but in fact that there is not. And I'll be talking about number 4, how the monetary system actually works in brief summary before I get into much more deep detail in later videos. Now, to spend a little bit of time talking first of all about why you should care about all of these things. Now, for me personally, I wish I had known this stuff a little bit sooner. I got curious one day and just went down some rabbit holes, and the more rabbit holes I went down, the more curious I got, the more that I wanted to solve this puzzle. Now, I haven't studied the monetary system as long as some people. There are people with PhDs that I would argue that probably still don't understand the monetary system after studying it for years and years. But I don't think that it's a worthless pursuit. I think that there is value in doing this. And after learning what I know so far, I wish I had known some of this stuff sooner. Earlier in the year, I myself had invested in gold, I invested in silver, I invested in Bitcoin because I was risk adverse. And the more that I study how the monetary system is, I don't think that this makes sense in theory. Although at the time, I still, looking back at these investments, I think that they made sense just because they were undervalued. But in terms of where they are now, I don't think these investments make sense, especially as the prices are high. And a lot of that has to do with how the monetary system actually works. So I've watched a bunch of channels, I've watched a bunch of YouTube channels, and I see people saying, the stimulus money, it's printing money. The Federal Reserve is printing $2 trillion of cash. This is influencing the monetary system, and this is causing stocks to go up. And that's not how it works. After learning all of these things, I've become much more aware of the world around me, and I'm really happy that I have learned this, so that I hope that you guys might go down this journey like I have as well. First of all, like I said, I wish I had known this sooner, and that there is a wealth. There is so much information that you can derive from economic data. We live in the information age. There's so much information out there if you seek it. 10, 20 years ago, just finding out this stuff would take decades, and you can learn it literally in days or weeks because of the tools that are available to us, right? And one of the advantages of knowing how the monetary system is, and or at least having some basic understanding of some economics, it can help you know where things are going to go heading in the medium term. Now, humans, we aren't fantastic predicting the future, but I would argue that if I can predict how things are going slightly more than 50%, let's say that I can predict the future 1% of the time above a completely random metric. Let's say I can predict the future 51% of the time. If I do that, and some of my trades are also asymmetric in those returns, that should make me very profitable. Now, will I beat the average S&P returns? Maybe, maybe not. But if I devote myself to this, I understand this more and more. Let's say that I can predict the future 5% of the time, accurately, 5% more than random, right? That should make me, in theory, very, very, very profitable, right? So, and also, most people, they don't understand this. They are manipulated by the system. They can't divorce themselves from it, and they allow the system to dictate their own actions. So if you can understand how the system works and divorce yourself from it, you can exploit other people's tendencies. And one of the things I'd also like to say is I follow a lot of very, very, very intelligent people. And the more that I've listened to them and the more that I understand the monetary system, and I don't want to say that I'm better than them in any way, because I'm not, but there's a lot of really smart people that they don't understand it. And I think they would find tremendous value if they spent some time to understand this thing. And that doesn't mean I disrespect these people. That doesn't mean I will change my opinion and I won't listen to them anymore. But it's just kind of eye-opening when some of the people that you really, really, really follow and respect and have tremendous knowledge still do not understand the fundamentals of money. Okay, so I want to start something, kind of frame a lot of things in perspective. This is something called loss aversion. This is a typical human behavior. I can't explain why it has happened, why it exists. Probably from something called evolution. Perhaps back in the day, there was some reason for this to happen that increased our likelihood to survive as a species. Now, this is something that I have become very aware of, especially as I've played poker. And that is these two things right here. First of all, pain from loss typically exceeds that of the pleasure from gain. So let's say in the stock market that you lose $1,000. Let's say, frick, that sucks. I lost some money. Typically, that feels worse than the pleasure you would gain from making $1,000. So if you made $1,000, that would feel good. You might feel awesome, but it's going to feel not as awesome as this would suck. Losing $1,000 feels worse than the great feeling that you have from making $1,000. Yeah. So one way you can think of this is, think about any time that you've been robbed. For me, I've been robbed a couple of times. I've had my car broken into, I've had some stuff stolen from me. It sucks. Recently my car is broken down, and that's some money I've lost, and I'm thinking about these things and how I feel compared to the stimulus check, for example. The stimulus, they mailed me $1,200, and I was like, yeah, okay, that's cool. I got $1,200, but the $1,200 that I gained actually felt, it felt okay. It felt good. It was awesome. I got some free money, but it didn't feel as good as getting robbed or my car breaking down felt worse. Even though I would say that the monetary benefit of the stimulus check was probably greater than the sum of those two former things. Now, for me playing poker, I'm very well aware of this. I've been a net winning player in this game over my lifetime, and I would say losing really, 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 really sucks, especially when you go on a losing streak for a long period of time. There's a point when it eats you psychologically, and for a lot of people, it influences their game. I might win a tournament, for example, or I might win a cash game and make some money in a night, and I'll feel awesome, right? But the next day, oftentimes, it's not going to influence me that much. But on the other hand, if I have a losing session, or if I have a couple of losing sessions in a row where I lose money, it bothers me. It eats me, often for the next day, next couple of days, right? And this is because of these emotions that are tied to loss aversions, right? And you think about, it makes sense. Why would we have industries like the insurance industry? Why would there be things like that? Why would you go to Walmart? Why is there an industry? Let's say your headset or whatever it is that you're buying. You're buying a mouse from the technology at the store. Why do they offer you these insurance plans? How is this industry profitable? It's because of this thing called loss aversion. And I think that this is important, and I'm going to explain a little bit why. Actually, I wanted to show you guys this really briefly. This is a very famous, probably the most profitable tournament poker player of all time. His name is Phil Hellmuth. He's on a television show. He is playing poker and he's losing some money. And I wanted to show you this in terms of loss aversion because I think it is fascinating. This should be someone who has mastered this emotion, and he's not able to do that.
Is this fucking for real?
Sorry, buddy.
I don't even know why I play poker anymore, I'll tell you.
PEMM.
I can't take it. I mean, I'm telling you, it's just, this is ridiculous.
Now, I want you to keep that loss aversion idea in the back of your mind for a moment. And I'd like to show you guys this. And if you've lived in 2020, you might have heard of the meme, or at least seen it, where there's the printing press with Jay Powell and he's printing some money. Or you may have seen this thing that I'm about to show you in a second. And I would like to keep that in the context of loss aversion and think about that for a moment.
Your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
An infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
There's an infinite amount of money at the Fed. In fact, there is not an infinite amount of money. The Federal Reserve legally cannot print money, but they can legally lie to you. Now, the goal of the Federal Reserve is, in some ways, to create some economic stability. However, the Federal Reserve, like most central banks in the world, cannot create inflation. Now, there are some in some parts of the world where they can print money, but the Federal Reserve is not one of those. In fact, the Federal Reserve was created rather to do the opposite. They were created to limit inflation. So historically, most European nations understood that inflation is a problem for society, and through creating their central banks, did this because they did not want inflation. They understood if they look at, for example, the Weimar Republic and things like that in Europe, they saw the problem of inflation, and so they created these central banks, and they limited their power to mostly not be able to print money. Yeah, and the United States certainly cannot. Now, where we see that recently that the Federal Reserve has said things like, well, we're going to let the inflation rate run hot at 5%. You know, now if you believe that there is going to be 5% and you are loss averse, and you realize, and you at least believe what the Federal Reserve is saying, that they can create this inflation, that they can print money, and that they can create this inflation, you will actually go out and you might spend that money. Now, I would argue that a lot of this, at least in the recent the coronavirus environment that we found ourselves in, has had kind of a Cobra effect. A lot of this money isn't going to the places that the Federal Reserve and the government would like you to go, or like you to spend that money in. They want you to go out. They want you to go buy a new TV. They want you to go with a stimulus check. They want you to go and, hire somebody to clean your carpet. They want you to go buy a new car, whatever it is, to go and spend that money into the economy. But most people in recessions, they are risk adverse. Now, if you think about that in the context of the place that we've been, where you've been stuck at your house, there's been lockdowns, there's been second lockdowns in some states, and you can't go and spend that money. And on top of that, you're scared of what's going to happen. And you're thinking about how this inflation is going to affect your dollar. Well, what are you going to do with that money? Well, maybe you'll go out, maybe you'll go buy gold. Maybe you'll go out, you'll buy silver. Maybe you'll go out, you'll buy Bitcoin. Maybe you'll go and buy stocks. You'll buy these inflation hedging assets. You'll buy things that should do fine because of at least during a high inflation rate. But if you understand the monetary system, you should understand that you are being manipulated and that the Federal Reserve really can't do any of these things. Now, I'd like to show you guys the past roughly 10 years during the stock market. Could have gone further. We've seen these inflation rates quite low, longer than this. But you can look in, for example, the past 10 years, and you can see that our inflation rate is much, much below, on average, 2%. Now, the Federal Reserve has a target inflation rate of 2. They think that's the healthy rate of growth that they, at least in the monetary supply. And if they can have you go out and they can do something to either increase or reduce your behaviors, then they can alter this inflation rate, right? But I would like to show you this. In 2015, and keep in mind that the Federal Reserve has a mandate of around 2%, they increased the interest rates because they noticed that the economy was expanding, it was doing quite well. And during that year, we as a nation, achieved an inflation rate of 0.1%. Now, I'd like you to also show you guys this. In 2020, we were doing quite well in the beginning of the year. We had a relatively robust economy, and thus we had a reasonable inflation rate. But because of March and April and the months following, we had the lockdowns and things like that, and the inflation rate went very, very low. In the months following, there was the stimulus checks, and thus we had short-term inflation as that money hit people's accounts. But I believe that this is going to roll over, at least in the short and medium terms. All right, now I wanted to show you guys this. This is from a couple of guys, Johnson and Brunetti's, some private retirement and investment specialists. But I was listening to a podcast that they released recently, and they were talking about where the $2 trillion stimulus comes from. And I thought they kind of explained it a little bit better than perhaps I might be able to. So I'd like to show you guys this.
Let's start with that first question. Where does the money come from? When people are saying, all right, so here's $2 trillion for this, bill signed, passed into law, here you go. Explain.
Well, to keep it really simple, we're borrowing that money from the future. The U.S. ultimately, whether they already have or they will in the future, issues bonds, and they take the money that they get from selling bonds to the public, and they either buy assets. In the case of what they're doing with the banks, what the Treasury is doing with the banks, they're buying securities so the banks stay very, very solvent. Or in the case of putting money out for some of the loans and the grants that are going to small businesses, again, they borrow that money and send it out into the economy. What the Treasury is trying to do and what the Fed's trying to do is, the economy, think of it as a stream, right? Money just washes through the economy. And if you put a dam in that stream and you dry up the flow of the water downstream, you've got all kinds of problems that happen. So the government wants that money washing through. So what's happening is ultimately they're going to borrow the money. Some people say print the money, but technically they're borrowing that money to be paid back at a later date. Where do they borrow that money from? Well, they still can borrow the money from institutions. People will buy government bonds. Government bond is a loan to the government. A lot of foreign countries will buy those bonds. We are still, despite what some people want to believe, the envy of the world when it comes to financial stability. We have the strongest, most resilient economy in the world. And so the idea is the Fed or the Treasury will ultimately borrow that money, give it out into the economy, and then they will have to pay interest on that money they've borrowed. But right now, interest rates are really low. And in the future, as the economy grows, paying back those loans becomes a much smaller percentage of the ultimate cash coming into the economy through tax revenues. So a little complicated there. Hopefully that was a simple explanation, but the money doesn't just come from nowhere. It gets either borrowed, it gets borrowed, period.
So essentially, the money doesn't just get printed. The Fed can't print money. They borrow the money. Now, I would argue that borrowing the money is inflationary in the short term, but you have to think about where this money is being spent. Now, anytime that money is borrowed, anytime we have a debt-based economy, anytime that you borrow money from a bank, that increases the money supply. So the Federal Reserve isn't any different. But if you think about where this money is being spent in the broad economy and other conditions, which I'll be talking about in further in more videos as we go into this topic, ultimately it doesn't really increase the money supply as much as people would think. Now, first of all, money is created from loans. I want to show you guys this video first of all.
When banks make loans, it actually increases the money supply. How does that work? Well, the money supply is the total amount of money available in the economy at any time. Suppose a bank has $10,000 in deposits, and it lends out $9,000. That loan initially increases the money supply by $9,000. Now, if that $9,000 is deposited in another bank, and that bank keeps 10% in reserve, $8,100 could be loaned out. Repeating that cycle over and over again until there's nothing more to lend, it turns out that the original $9,000 loan can increase the money supply by a whopping $90,000. That's how money is created. The opposite is true too. When people repay the loans, it shrinks the money supply. Here, when the first $9,000 is paid off, it reduces the money supply by $9,000. However, the bank will be quick to relend that money and return the money supply to its original size. In effect, money is being constantly created and destroyed and created again through banks' loan-making practices.
Okay, so when the Fed borrows money, it's not much different than most other people borrowing money. This does increase the total money supply in the short term. And we can see that. In the short term, the stimulus money is inflationary because it's a loan. And all money is created through loans. We have a debt-based economy. So we can see this. This is inflation rates for the year 2020. January and February, we had a relatively robust economy, and thus we had some relatively high inflation rates above the Fed's target of 2% at 2.5 and 2.3. But as the pervasive sickness started influencing people, and the government started responding to that in terms of government shutdowns, we can see that the inflation rate declined. So this should tell us that overall, that lending was tightening during this time. And it makes sense because people were going out and spending less money. The banks probably tightened up some of their lending requirements. And although there was some PPP loans and things like that, we can see overall that, the economy wasn't doing that well, and thus there was some deflationary pressures on the economy. But the stimulus bill passed somewhere around this time, and we can see that as a result, the inflation rate increased a little bit. Now, there was people during this time that were actually making more money than they were while they were at their jobs. And this, I believe a lot of this money has found its way into assets and things like that. And in any case, we can see that at some point around October and November, this inflation rate has somewhat declined. Now, as we head into the later parts of the year, especially December, we should expect to see higher inflation rates on average. This is because people go out during the holiday seasons, they like to spend more money. But if people are fearful, or if money is tight, or if banks aren't loaning money, which the first two things usually cause the other. But ultimately, if banks aren't lending money, we should see a lower inflation rate in December. So we'll just have to see. But because December is usually a stronger inflationary month, I wouldn't expect it to be much lower than November. But in any case, we can see that there was some inflation rollover in October and November. And one other thing is, when we're thinking about the debt, we're thinking about the government, and we need to think about where this money is being spent. Now, in the early months, money has been relatively loose for the average consumer. During these early parts, especially when we received the stimulus bill, people didn't have a lot of debt. They didn't have these kinds of things. I mean, we are Americans. They have a very high amount of debt overall. But in overall, in terms of relative throughout the year, at least in 2020, it money should have been at least a little bit looser in these months compared to where we are now. And the reason that's important is we have to think about where this stimulus money is being spent. Now, I have a couple of anecdotal experiences that I'd like to share with you. First of all, for myself, when I received the stimulus money, what did I do with this money? Now, I had a student loan. I had roughly, at the beginning of this year, I had around $2,500. And because I noticed what was going on in the economy, because I was perhaps slightly more fearful than, well, probably as fearful as most people. What did I do with that money? Well, I decided that I was going to pay some of that debt. So if I use this loan money and I go and pay debt, that actually reduces the overall money supply. So I owed about $2,500. When I received this stimulus check, I was like, you know what? I'm gonna go pay off this debt. So what I do, I paid off my student loan. Now I have a friend of mine. He works at a call center, and he did a similar thing. He had some credit card debt, and perhaps he was thinking some of the things that I was thinking. He said, you know what? Because the economy doesn't look that great, I'm a little scared. I don't want to owe money, especially when money might be getting tight. I might go and pay my debt as well. And I think there's a lot of people that are thinking very similar things. And if we look at the data, it would suggest some of this as well. Now, I'll probably show you some of this data in some other videos. And this is important for this point here. Private and public sector debt both matter. So if the Federal Reserve, it issues debt and it tries to put that money in the economy, that stimulus money, we have to think about where that money is going. And this is particularly important when we're thinking about 2020. You know, a lot of people, they've been locked down. They haven't been able to spend this money in the broad economy. And perhaps they've been fearful, right? You've seen, I think I mentioned this a little bit before, there's lockdowns, things like that. It's hard when you're sitting at home to spend this money in the broad economy. And when you're also fearful of the future, it isn't conducive to this. And on top of that, banks are also risk adverse. When they see this human behavior, when they see people spending less money, they don't want to give loans. And that leads to a lower inflation rate. Now, this is really hard, but I'm going to try and explain this a little bit more. Hopefully you guys found this so far, some of this useful in this video, and hopefully you guys can understand a little bit better, I think, what is going on in the stock market, what is going on. When people are so fearful of these kinds of things, when they're afraid of inflation, it causes them to do certain things. And oftentimes, because the Federal Reserve is so limited in what they can do, it can have some unintended consequences. But again, I'll be talking more about this, and I'll be proving this with some more data in some future videos. If you found this useful, I would greatly appreciate a like. And if you have any questions, feel free to leave a comment below.